$3.1 trillion sits in Australian trusts right now, and 0.4% of the population takes home half of it. That's the biggest legal tax dodge in the country, and your PAYG is picking up the tab. I'll show you exactly how they pull it off. Every tax return you lodge subsidizes this. You cover their share. Stop watching now, you keep funding it. But here's the thing. The government just cracked down and gave the wealthy 2 years to dodge it. Say a family trust earns $100,000 in a year. Trusts exist for real reasons: asset protection, business structures, estate planning. But the maths creates an incentive that is almost impossible to ignore. If one person earned that $100,000 as a salary, they'd hand roughly $24,000 to the ATO. That's PAYG. You earn it, you cop it, you move on. But a trust doesn't work like PAYG. The trustee gets to choose where that money goes. They can split that $100,000 across 5 people. A couple and 3 adult kids who aren't earning much. Each person gets $20,000. And here's the number that changes everything. The effective tax-free threshold in Australia, once you include the low income tax offset, is $22,575. $20,000 sits comfortably under that line. 5 people, $100,000. Zero tax. Completely legal. That's not a loophole buried in the fine print. That's the system working exactly as it was designed. And it has worked this way for decades, while the rest of us file our tax returns through MyGov and pay full freight on every dollar we earn. Now scale it up. A trust earning $200,000, split among 4 family members, pays roughly 12% average tax. If one person earned that on PAYG, they'd pay over 30%. That gap is almost $40,000 a year. Every single year. And the trust doesn't need to be complicated. Setup costs a few $1,000s. Accounting runs a couple of $1,000 a year. For a family earning $200,000 through a trust, that's a return of roughly 20 to 1 on every dollar spent running the structure. No investment in the country gives you that kind of return. Not property, not shares, not crypto. Nothing even comes close. And that return only gets better the more you earn. So why don't more people know about this? Because there's no public register of trusts in Australia. The ATO doesn't even maintain a list of trust deeds or beneficiaries, so tracking who benefits and by how much is genuinely hard, even for the government, which raises a question you probably haven't thought about. If nobody's tracking the money, who is actually pocketing all of it? I told you, 0.4% takes home half. Now let me show you what that really looks like. Less than 0.5% of Australians earn over $500,000. 0.43% to be exact. They receive 51% of every dollar flowing through trusts. 51%. Meanwhile, 96% of Australians, everyone earning under $180,000, shares just 13% of trust income between them. The top sliver takes 4 times more than the bottom 96% combined. This isn't a few clever families finding loopholes. This is a parallel tax system sitting alongside PAYG. One for the wealthy, one for you. And here's the number that proves it. Families using discretionary trusts pay an average tax rate about 4 percentage points lower than families on the same income without one. 4 points. That's roughly $1 in every 25 you earn, every single pay cycle, for your entire career. If you and your neighbor both started working at 25, by 50 they've paid for a house deposit less tax than you. Same job, same income. They just had a different structure. Over a full career. That gap compounds into hundreds of thousands of dollars you paid that they didn't. And nobody sent you a letter to explain the difference. 823,000 trusts sit on the ATO's books right now. That number nearly doubled in under 20 years. The wealthier Australia gets, the more trusts appear. Because the incentive only grows. When you can legally turn $100,000 in earnings into $0 of tax by writing 5 names on a distribution statement, the system is practically inviting you to use it that way. Every year the threshold goes untouched, the invitation gets louder, and nobody in Parliament touched it for 2 decades. The people who can afford the setup are exactly the people who benefit most. It's a structure that rewards you more the wealthier you already are. That's not a design flaw. That's the design. And it's been running in the background of the Australian economy since the 70s. So the government finally moved. In the May 2026 budget, Treasury announced a 30% minimum tax on discretionary trust distributions, expected to raise $4.5 billion over 5 years. On paper, it's the biggest trust reform in a generation. But here's the part the headlines didn't tell you. It doesn't kick in until the 1st of July 2028. 2 full years from now. That's 2 years for every well-connected accountant in the country to restructure their clients. 2 years to shift assets, rearrange distributions, set up new entities. But before you assume the reform is dead on arrival, look at what it was designed to fix. Picture this. You earn $200,000 a year on PAYG. You pay roughly $60,000 in tax. Your neighbor earns the same $200,000 through a trust, splits it 4 ways, and pays about $24,000. That's a $36,000 gap between you. Every single year. Over 20 years. That adds up to more than $700,000. You both send your kids to the same school. You both shop at the same Woolworths. You both vote in the same electorate. But every April, one of you writes a check for $36,000 more than the other. Same street, same income, completely different outcome. The 30% minimum is supposed to close that. It would bump your neighbor's bill from $24,000 to $60,000. On paper, the gap disappears. Except 350,000 active small businesses run through discretionary trusts right now, and Treasury itself admits 40% of them won't need to pay extra tax or restructure at all. So who does this actually catch? The families splitting $500,000 across non-working relatives have 2 years and an army of advisors to rearrange everything before the floor even takes effect. They'll set up corporate beneficiaries. They'll restructure distributions across entities that sit below the threshold. The advice industry is already selling 2028 planning packages. Meanwhile, the PAYG worker watching this doesn't get 2 years' notice before their tax rate changes. When the tables move, it comes straight out of your next pay. No restructuring window, no planning package. Your tax just changes. Theirs gets a 2-year runway and a team of professionals to optimize it. The tradie running a legitimate business through a trust, the one who isn't splitting income aggressively but uses the trust for asset protection, might actually be the one who gets squeezed. And that's the pattern with Australian tax reform. The headline sounds transformational. The start date buys time. And the people with the best advice find the gaps before they close. It happened with capital gains. It happened with superannuation. And now it's happening with trusts. And unlike negative gearing or franking credits, there was never a real public debate about this. No election was fought over it. No Prime Minister made it a signature policy. $3.1 trillion sitting in structures that most Australians don't fully understand. Almost no scrutiny until now. The real question isn't whether trusts should exist, it's whether a 30% floor, starting 2 years from now, with exceptions carved out for 40% of structures, actually closes the gap between what the wealthy pay and what everyone else covers. Or whether it just moves the goalposts for people who are always going to find them. If you have a family trust, check your family trust election before the end of 2026. The ATO's correction window closes in 6 months. Errors going back decades are being flagged right now. Don't sleep on it. The 30% floor lands in 2028. When it does, I'll break down exactly who it actually catches and who walks away clean. Subscribe so you don't miss that one.